Hello, ladies and gentlemen, and welcome back to a very special episode. Non-farm payrolls, the jobs numbers, often considered the biggest economic data of the month, are coming out in less than 24 hours. And at a key resistance support zone, we've discussed 3900, 3920 all week, whether it be on our Twitter, our Discord community, or of course here on YouTube. This was our major support. Luckily for us, so far, the market has bounced off that area. But does this mean it's time to take away the bear boots and say, okay, it's time to go bullish? Well, maybe this is something that kind of occurs in the future. A rally towards options max pain expiration we'll talk about, and also a potential for a little bit of reprieve in what has been a decent sell-off so far. You have to keep in mind though that there are plenty of bear case scenarios, and we need to discuss all of them because trading is all about having an open mind to the situations that are presenting themselves. Stay tuned, we've got over 200 years of data to talk about. See you soon. Well, welcome back everyone to the Daily Show where we talk about stocks, commodities, and cryptos. We've got some amazing levels to talk about in today's video. We'll go through the macro, almost 200 years of data, what bear markets, whether we're in a massive bear market that's going to get much worse, and everything else. We've then got the key charts to be discussing. But we're in September. Welcome to the worst month of the year historically in stock markets and markets around the world. During presidential cycles, you'll notice that not only is September bad, but it also tends to be a really poor period of time in these presidential cycles. What happens after this point, though, into October is a big turnaround. Here is 1931 to present in terms of what happens. Usually around that middle of August, similar to 2022 so far, we start to drop off. Coming into the early part of September, we often stay similarly kind of like, you would say sideways to up, and then we have a dive at the back end of the September into October months. Will it act the same? Here's a bit of a chart of what often happens at the beginning and often happens at the end. I think we need to keep an open mind and of course follow the technical analysis along with the current sentiments in the markets. We've got a new week and of course a new sentiment report in terms of what the retail traders or the AAPL sentiment traders are thinking about. They've gone super bearish. 50.4% of people are bearish. This is a reading that we've seen before end up countering and becoming a bullish, sometimes a blip on the horizon. But of course, everyone's gone bearish now. And this is up from 42% and 37 and 36 previously. For anyone that's been watching the channel for a while, you'll know that we've used this quite effectively along with other things to try to find the key zones where markets potentially turn for a few days. A very interesting point and of course worthy of discussion. So in these case scenarios, let's say we're talking about September. Yeah, we know it's weak. I think everyone knows that now. And yes, you might say, well, it doesn't work. History would say September is a pretty horrible time. Now, let's have a look though. What about recessions? Well, whenever we see 50% of all the yield curves, this isn't just US 2-year versus 10-year or 3-month versus 10-year. This is all the yields across the bond market. Over 50% of them, we've seen a US recession. So that helps us because it gives us these case scenarios for what's going to happen next. Here's another big bit of data that's very interesting about 200-day moving averages. We know that's a big thing. 90 days with a declining 200-day moving average. You can see the dot points where that has happened in the past. And I've got to tell you, the statistics don't look too good around it. It really points more into this idea of kangaroo-style market. That is a market that goes up, goes down, goes up, goes down, and then possibly just drives lower over a period of time, possibly the next month and a half, because that's what these stats start to say. Less than a coin flip chance that the market is up over the next 2 to 3 months. Now, if you know your history with markets, usually around 59% of each day is actually up. The markets are geared towards the bull side. So in not only a bear market, we also have these leading indicators that kind of tell us that the weakness could be still coming. So if we know that over 50% of all yields are inverted, we kind of can assume that a recession, whatever they call that now, is on the horizon. In similar bear markets since the 1800s, how long has it taken to recover? Well, the good and the bad news is usually if it's not event driven and it's more of a long-standing economic kind of failing, which is what inflation is to a degree, we could be going into a very long period of kangaroo style market going down. In fact, the median here is 18 months in length. Now, of course, you know that it started in 2022, so we could be only just in the beginning of all of this. You've got to keep an open mind to these scenarios. We also know that the markets showed us some interesting thrust and breadth. If you've been watching the markets for the last month, everyone was talking about that. In the recession style cases where markets basically were showing us that there was a recession on the cards, all of the correlated periods were deep dives back into those lows. We saw basically dips followed by the bullish momentum. So even the bull cases where further dips were coming. In the bear cases, of course, it was more of an apocalypse and we saw way lower points. And you have to keep an open mind to if we see new lows forming and it starts to drop off, then we could be in these style scenarios. And a lot of people on this channel truly believe we're in that. And of course, if you believe it, then you've got to keep the powder dry and have a plan around it. What about the VIX? Well, the volatility index, we always speculate around 20 is a key level and around 35 is a key level. This is fear. This is greed. In a bear market, this is the way you look at it. Everything in between is kind of like a middling zone. But of course, anyone that's purchased VIX at 20 would be pretty happy still with where it is. It dropped in the last 24 hours. And the main reason was because we found support. And of course, that led into some buying in these markets overall. But I don't think we can get that much from the VIX at this level. What about yields? Well, leading into the non-farm payrolls, with the economic data coming out from Europe, it looks like inflation still hasn't peaked there. And many economists believe it's going to go higher. In the US, there's a good chance that we've kind of gotten to that top, but it's going to remain sticky. And this is the important factor when we look at yields. So here's the 2-year yield. And you look at this and you think, oh, 3.5%. That's pretty high. Well, here's the big issue. If I go through and I actually show you here the interest rates coming into next year, 2023, let's go over to, let's say, April 2023, 3.95%. We almost have a 4 handle, which is what the bond market expects the federal funds rate to get to, 4%. We're starting to talk in some very dangerous territory. If it goes past 5, I've speculated, bond market traders have speculated, I've talked to some very rich billionaire kind of hedge fund managers about this, and they've all said that if we get past a certain tipping point where the Fed's fund rate goes too high, effectively that will be like a tipping point that will be the straw that breaks the camel's back and everything will go bad. So the Fed has to be careful. What's more likely, and this is what the bond market's telling us, is that the market will have to remain at a very high interest rate for longer with less cuts. This is of the new economic data, which of course the Fed and the Jackson Hole Symposium and all these other things, they've said they're not pivoting till they kill this inflation. So they're going to have to remain very high until the inflation number comes under this number here, this big yield number. So when they get, let's say it's 3.8%, and let's say they're sitting around that level, if inflation comes under and sits under that level, that'll be when the Fed will pivot effectively. At this stage, that's what the market will need to look for. So it's something important to understand. If we think about US 10-year rates as well, if we look at the yields, they've been steadily climbing here. In fact, it got through my little bit of resistance that I was looking at. And I think, it doesn't really matter. But what this is telling you is that in general, if we're seeing yield this way, usually in the market, you'll actually see metals and inflation-based assets doing quite well. That's not happening. Very surprising at this point. We're seeing demand destruction. This shows us weakness in the economy. It has been driving the US dollar, and the US dollar's broken to a new high here. You can see at 109.60, but we're leading into non-farm payrolls. Picking this one's going to be very tough over the next 24 hours. In fact, I would probably stay away from it myself. And the reason why is because non-farm payrolls could easily drive this right back down, or of course, push it into next levels. I think this is one that, because we're leading into a long weekend, if you're a scalper, you're a day trader, maybe you like it. I think it's a little bit dangerous. What do you guys think about in the comments down below though? This is a nice breakout. Sure, it might look on the surface like it's keep going up, the easiest trade, everyone's talking about it, but it could easily reject back through and then go back into this effectively distribution. Could this be a UTAD? Remember, Wyckoff basically said that this is the way that markets trap. We've got to be very careful here on the US dollar. The reasons why this is also there is because of gold. Now, we've been following gold very, very well. And of course, we've so far been pretty correct here on the channel. We talked about it buying off this level. We talked about it selling off this level. And so far, we're looking in this zone for turnaround signs towards the buy side. Have we had any? No. We often said in the start of this week, we often talked about 17.15, 17.10. Well, at the time of this recording, we're underneath that level. So you've got to learn that the market will structure up in such a way. Catching this falling knife is tough. Let's take a look at the actual trend ranges. If we take the distance from here to here, the top to the bottom, and we extrapolate that out, it basically points towards the market potentially going all the way down to these lows again. Could that happen during non-farm payrolls? Absolutely it could. And it's something that you need to keep open. But what we want to do is look under the hood. We need to go down to the smaller timeframes and work out the key areas of resistance moving forward. And I've kind of marked them here on the chart. We've got the 17.25, 26 kind of zone. We have that 17.11 kind of area to 17.07. That is a key resistance moving forward that you'd want to see broken to show that the market's ready to recover. And then we have a very small one around here just underneath 1700. Again, which is the strongest one? I would say this is the strongest one, followed by this level here. Down here is a little bit questionable, but if for scalpers and day traders, they're going to be looking for a break of this level, a small pullback, and a recovery after that. This market's starting to extend away from moving averages to the downside, and that's important because it allows that rally through. Non-farm payrolls, 1 hour before the New York Open, that's going to probably be the catalyst here. And remember, with non-farms, the way it often works is it goes like the opposite direction or the other way before moving through. It often goes one way, then reverses that a few minutes later to an hour later. You've got to be very careful with this economic data. If you've never watched one before, be careful, guys. It's well known for that. So we talked about yields going up. Usually that would mean oil is going up. Oil has not done so. Of course, we talked about the weakness. Basically, all our bullishness turned bad here. So far, so good in terms of it going bad. I am bearish on oil over the next 6 to 12 months. I think demand destruction is well on the way, and I'm looking well lower for oil. But we're talking about the here and now. Are we at a support? Yes. Is this support strong? It's decent. Certainly is quite strong. Would buyers be looking at potentially purchasing in here? Possibly. Do I like it? Not enough. We're not seeing the base that I would like to have. But I'm just showing you that yes, it's at a key level ahead of non-farm payrolls. I think we'll have to come back to this one next week. This is UK oil, which is different from US oil. Often it leads, so make sure you look at Brent versus US oil whenever you're doing oil trading. It's very important. If we move over to Tesla, a little bit of recovery through the session, which is pretty good. And this is boding okay leading in. I mean, if we get a new high here and it goes through the price of 280, that's kind of really, or even just around here at this 277, 280 kind of zone, this really bodes okay for a potential recovery, maybe even upwards of 290 plus or even a 300 for Tesla. It always seems weird to say these numbers, yeah? These stupid splits, they're ruining everything. We've got shop splits, we've got Tesla splits, Amazon, oh wow. It's like numbers that I've known for years have blown out the door and you can't even think about it anymore. So now that we're back in here, there is really a good chance that still the market goes bearish at some point to fill this gap. I think this is a very good case scenario for Tesla bears. But this is the problem. Everyone's turning bearish. If we go over to Apple, it hit a 50% fib of the last pullback. It obviously didn't hit anything of this particular pullback. We filled the gap at 156, 157, and we're currently finding some bullishness. Now, it's not really so much the Apple chart or the Tesla chart that interest me. It's more the SP500 and Nasdaq that we'll look at in a second. But I do want to mention Nvidia because Nvidia just swung the low. Here's the low over here. This is the demand area. It got absolutely brutalized by that news of the US government saying you can't sell the chips. Huge volume, the most shorted stock on the index at the moment in terms of the big stocks. Everyone's been shorting it. Pelosi sold at the top. She's a beast, there's no doubt. I wonder why, some people would ask, but anyway, we won't speculate on that. And we now know that there's a potential gap close over here. So this is a fairly strong kind of move. That would have taken out a lot of people's stops. A lot of people would have been freaked out by the Nvidia move. Being patient here was the key to wait for it to potentially come down to that level. Remember, a trader is like a patient grasshopper. You've got to wait for it to come to you. It's not, you don't feel the FOMO. There's an abundance mindset. You've always got to come from it from that perspective. We do not feel FOMO. There is no FOMO. There's just a good trade at a good position. And if you love a stock, let's say you love Nvidia. I love Nvidia. It's great. I can see the AI. I believe in the future. You probably shouldn't trade it. It's your investing, because otherwise you're going to trade vest it. You know what I mean. Comment down below if you've trade vested before. If you love something, it's better not to trade it. I love Microsoft. Now, you might say, well, why the hell would you like Microsoft? I love moat. So that is basically the ability for the company to never be touched by any other company because it's so big and it has so much competitive advantage. You know, are they probably partially evil sometimes? Maybe, I don't know. But the thing is that they have a massive moat. So that's a company I love, but at the same time as a stock investment, but I wouldn't trade it because I would trade vest it too often. Let's move over to the Nasdaq. Nasdaq here, big deal. So we've hit the bottom of our trend line. I'll just go to the daily so you can see what we're talking about. This was the trend line we mentioned the other day, a limited micro kind of support. We've come down and we've tapped into our massive liquidity pool. Effectively the demand, the previous resistance, the support. What else do you want? Lots of things are here. Gaps, all sorts of things. We've since rejected that with a fairly decent, what looks like bullish hammer on the futures market. And we've hit that topping range. But when we go into the smaller timeframes, let's go to the 15-minute. What you'll notice is the market structure looks decent. Now, the way I would expect this to play out is actually something like this. And the reason why is probably non-farm payrolls. It could still go bad. It could obviously make it down to the lows. But what you're doing is you're finding a key level. I'm here to tell you that I believe, my belief, that this is a fairly key level. And I said that at the start of the week. If you go back, watch our Sunday video, detailed analysis on the SP 500, went on about it for about 10 minutes, that when we got down to this level, it was a critical point in the markets. And that's what you like to focus on as traders. So we've seen kind of like a movement here in the market, movement down, up, and then of course, potential of a pullback during the non-farm payrolls or the futures market showing weakness, profit taking, all sorts of things, and ideally some form of pickup in this range towards the bull side. What's the bull side look like? Well, the S&P 500 helps us the most here, but of course you can see the targets. You'd look at things like a 12,450, a 12,600, or ideally back into like a 12.8. Imagine if it did this. Boom, down. That would be a big one. It would get a lot of people bullish. It maybe pushes a little bit too far for them as well. That would be excellent in terms of just trapping everyone's mindsets and then going bearish later on. We saw a poll taken of Tuesday and it showed us that over 50% of people were bearish. The problem with that is that if everyone's bearish, that means there's a stacked amount of puts. And we'll show options in just a few moments to look at these puts in the unison of this market. But basically speaking, there are potential resistance levels. And of course, if the market goes underneath this, well, it's hugely bearish. And we could be in for what we call capitulation, a monstrous fall off of many percent that will have everyone freaking out in the street. That's something that's also an opportunity. Trading is statistics. Trading is trying to find key levels. And then, of course, to look at those. We also discussed this a few weeks ago, which helped us to really define that probably we were looking at a market that was starting to top off. Russell 2000 versus SPY. This ratio is going to be, I believe, critical to really get us out of this bear market. If we see this going above that 0.4 kind of 8 zone, it points towards the smaller caps starting to outperform the S&P 500. Usually if a market comes in and we're seeing a bunkering, basically a fear in this market, the big caps will hold better than the small ones. It just makes sense. If we see a relaxing of money flow, usually the small caps will outperform the big caps. So this is something that is a good ratio to have on your charts. Let's move over now to one of the most important markets in the world, which is of course the S&P 500. This is the one that often creates the catalyst. Here we have the fib pull of the entire move. 61.8 fib was hit. 39.220 gap was closed in the previous session. Previous resistances, previous supports. I could go on and on and on about why this is a potential critical level. And when we start to scroll in on the smaller timeframes, and we'll do so using the futures market, you're going to start to see that there is again a similar style structure forming. We've had a market that's gone sideways for a while. It's gone bearish. It's gone bullish. It closed bullish, and then we're leading into the non-farm payrolls. It allows for this type of thing to occur. I mean, it could, of course, go up. You've got to be patient as a trader and pick your levels. If we make a new low, well, that's quite bearish. We'll talk about that in our weekend video, and maybe we're going to 3750 or even a low 3800 at that point. You would think that they're the most likely kind of scenarios. But at this stage, there's a real case to be made for potential bullish action. And I think that's important. Everyone else is going to be bearish, and I understand. I totally get it. This market could be a horror show. In 3 months' time, we could be looking at a market that's much lower. We could also be looking, though, you have to keep an open mind, at a market that's above 4,300. It's possible. Anything's possible. Keep an open mind and adapt to those situations. That's what a trader and an investor effectively has to do. If we think about the key resistance levels, 40.90, 41.25, these have not changed this week. They're still the key resistance levels. Everything in between there is a bit of a questionable area. If we think about options, where are the key options expiring? This one here, 400 or 4,000. Let's have a look at the options together right now. Let's refresh this because we're leading into the bigger options expiration, which is the Friday. Here we go. 403 is max pain. We're currently trading underneath that. Where are the big option strikes? Well, they're all starting to stack, as you can see on the 400. These guys, no soup for you, as they say. So you're not going to get any money. Yeah, that's not going to happen for you, most likely. But of course, there's 370, 380, 390. You can see it gravitates to these $10 increments. And this is the one that a lot of people have got looking at. So this has been dropping. I mean, I think it was about 416 only a few days ago. So you can see that there's been a huge amount of war both ways between the bulls and the bears. Look at all those calls that are opening on the top end. Someone went very bullish here, as well as people have gone very bearish. So even if it just sat here, it would actually be doing a pretty good job of max expiration. But obviously above 400 would be the perfect level for, at this point in recording, where the market would close. And that's an interesting point. Of course, non-farm payrolls, we'll see what happens. What about Bitcoin? What about Ethereum? Well, Bitcoin is starting to look better. This is critical up here. This is critical potential short action up here. But at the moment, it's made a triple base. It hasn't broken through. You can see it's kind of got that series of lower highs coming in on it. For Bitcoin and the rest of crypto to actually show some form of recovery, it has to actually do something. And Ethereum has shown us more of the way recently than Bitcoin. Bitcoin looks pretty crappy on the charts, but I will say this level and this level are pretty important potential shorts in the future. The market looks quite sick on Bitcoin. So even if we see a bit of a pickup, it does get kind of sick. In the previous video, we discussed this level getting picked up by the market. So far, so good, and Ethereum has come good for that. 1700, of course, could be a target you have on Ethereum. And at this stage, as long as the stock market goes up, the crypto market is also looking towards that side. New lows, watch out down below, guys. Crypto could get smashed. I mean, if Bitcoin goes through 17.5, we could be looking at like a 13K or even an 11K pretty quickly on something like the crypto market. You got to be very, very careful. Set those longer term alerts. If you haven't already followed us at FX Evolution, do so. You can look at the links down below. You can also just type in FX Evolution on Twitter. We have a Discord community of over 10,000 people in the public community. And if you're interested in our private streams and everything else, our private newsletter, that kind of stuff, then you can do so. Free 7-day trial in the links down below. So definitely check that out. And then we come to the big one here, guys. And this is the one. Non-farm payrolls. Woo! Every month it happens, and every month it usually lets us down. We'll find out whether this month it does end up creating some big moves. This is still one of the biggest economic data points. You might say, well, Tom, the jobs numbers are stupid. They're lagging the economy. Yeah, that's true. In 2022, it hasn't meant as much. However, it's still a big number. And why it's so big is because no one really knows how to interpret it properly. And that's why algorithms go everywhere during this number. You'll often see it come in drastically wrong from what the economists think. That's what makes it exciting. The fact that they don't predict it correctly. So this is the one, 8:30 a.m. New York time. Be there and make sure that you're paying attention. And you've just got to be careful with your scalps and day trades. Good luck, everyone. We'll have a special weekend video after non-farms for the long weekend, of course. If you don't watch that, have a great long weekend in the US. And of course, everybody else, have a great weekend. and good luck on the Friday session. Subscribe, smash that like button. We'll see you in the next one. Bye for now.